As the U.S. markets are currently closed for Tuesday, October 21st, 2025, we are looking at one of the most explosive moves from yesterday's session. GSI Technology, ticker GSIT, finished its day on Monday, October 20th, 2025, at a staggering $12.97 per share. This wasn't just a green day, it was a volcanic eruption, a gain of $7.89, locking in a 155.31% price surge in a single session. And the immediate reaction most people have is to write this off as just another low-float, speculative microcap gamble that someone pumped. The kind of stock you see flash across your Robinhood app feed, spike, and then vanish. But the expectation that this is random, unexplained retail mania is completely wrong. The reality is this move is anchored in something very specific, very technical, and potentially very disruptive to the entire artificial intelligence landscape. This 155% explosion was ignited by a press release, but not a typical self-congratulatory corporate one. This was news that researchers at Cornell University, an independent third-party academic institution, had published a paper. This paper validated GSI Technology's core Associative Processing Unit, or APU, and the findings are what sent the stock into the stratosphere. The study confirmed that GSI's compute-in-memory technology could not just compete with, but in one of the most critical metrics, demolish a heavyweight champion, the NVIDIA A6000 GPU. Let's be perfectly clear about what happened. The market has been, for the last several years, operating under the assumption that the AI race is a battle of titans. It's NVIDIA stock first, and then everyone else. The narrative is that all roads lead back to NVIDIA's CUDA platform, their massive GPUs, and their dominant market share. Investors piling into Fidelity mutual funds focused on technology are almost certainly overweight on names like NVIDIA, Apple stock, and Microsoft. The expectation is that true innovation at this level can only come from companies with hundreds of billions or even trillions in market capitalization. GSI Technology, a company that before this news had a market cap of under $150 million, was not part of that conversation. The reality we now have to confront is that the biggest challenge facing the AI sector isn't just processing speed, it's the energy wall. The amount of power these massive AI models consume is astronomical. The Cornell study specifically benchmarked GSI's Gemini-I APU against the NVIDIA A6000 for complex AI tasks, specifically Retrieval Augmented Generation, or RAG, and found that while it delivered comparable performance and speed, it did so while consuming, and this is the critical figure, over 98% less energy. That is not an incremental improvement. It addresses the single greatest scaling problem in the entire industry. So let's look at the anatomy of yesterday's trade. This stock didn't just drift higher, it was a violent repricing. GSIT had closed the previous session, Friday, at just $5.08. On Monday morning, following the news, it gapped up to open at $7.50. But the buying pressure was relentless. It rocketed through the morning, hitting an intraday high and a new 52-week high of $18.15. That is a 257% gain from the previous close. Of course, a move that sharp is going to attract sellers, profit takers, and short sellers trying to call a top. The stock was wildly volatile, pulling back significantly from that peak to finally settle at $12.97. But look at the volume. The stock traded an absolutely breathtaking 110 million shares. shares. To put that in perspective, its average trading volume is typically under 2 million shares. This wasn't just a handful of retail traders on SoFi Invest chasing a headline. This was a massive, fundamental repricing of the company's prospects, with huge blocks of shares changing hands. This is the kind of volume that suggests institutional interest, a sudden and desperate scramble to build a position in a company that 24 hours prior was almost completely off the radar. The platforms people used for their online investment decisions were likely strained. Anyone trying to get an order filled on Fidelity, Interactive Brokers, or Robinhood would have seen a spread that was a mile wide and a stock chart that looked like a heart monitor. This is what happens when a new reality collides with an old expectation. What does GSI technology actually do? For most of its life, going back to its founding in 1995, it was a quiet provider of high-speed semiconductor memory solutions, specifically static random access memory. They have a solid, if small, business in that space, including radiation-hardened memory for aerospace and defense, which is a very specialized, high barrier-to-entry market. But for years, they have been using their expertise in memory to develop this APU. The core idea is compute in memory. In a traditional system, the kind that powers almost everything from your phone to the biggest data centers, the processor, CPU or GPU, is separate from the memory. The system wastes an enormous amount of time and energy just shuttling data back and forth between the two. This is the memory wall. GSI's APU performs the processing directly inside the memory array. This allows for massive parallel computation without the data movement, which is why it is so much more power efficient. It's an entirely different architecture, and until yesterday, its claims were just that, claims from the company. Now, Cornell has validated them. This isn't like Tesla stock trying to build a new car. This is like a small company claiming they've invented a new kind of battery that's 98% more efficient, and then MIT publish a paper confirming it. Now, before anyone liquidates their Fidelity ETFs and dumps their life savings into this, we have to ground ourselves in the rest of the financial picture. This is still a micro-cap company, and it is not profitable. This is a high-risk venture. In their last report for the first quarter of fiscal 2026, they reported revenue of $6.3 million. That was a 35% increase year over year, which is very healthy growth, but it still resulted in a net loss of 0.08 cents per share. That loss, however, did meet market expectations, so they aren't wildly missing their targets. More importantly, a look at their balance sheet shows that they hold more cash than debt. This is critical. It means they are not in immediate danger of insolvency and have the capital to fund their operations as they try to commercialize this APU technology. They aren't going to be forced into a toxic financing round tomorrow just to keep the lights on. They have a runway. But this is absolutely a speculative investment. This is not something you'd find in a conservative Schwab Intelligent Portfolios robo-advisor account. This is the definition of a self-investing play, something you would buy in your individual brokerage account after doing a significant amount of your own research. The low institutional ownership, which was recently cited as a negative, may now become a positive, as it means there is a huge untapped pool of institutional capital that may now be forced to start looking at the stock. The recent short interest in GSI was also reportedly on the rise. That means a significant number of traders were betting the stock would go down. Yesterday's 155% move on 110 million shares of volume was almost certainly fueled in part by a massive short squeeze. Those traders who were betting against the company were forced to buy back shares at any price to cover their losses, adding jet fuel to the fire. This creates a feedback loop that drives the price even higher. Many of those shorts were likely placed using platforms like Interactive Brokers trading, which is popular for sophisticated short-selling strategies. Now, they are nursing catastrophic losses. The question for today and the rest of this week is, what happens now? Was that squeeze the main event, or was it just the appetizer? We've seen this story before with other tech stocks, but rarely with this kind of powerful external academic validation. So, let's talk about the future outlook, framed by this expectation versus reality dynamic. The market expected GSI to remain a niche SRAM provider. The reality is that it is now a validated contender in the AI acceleration space. And here is the next catalyst. The Cornell study was based on GSI's first-generation Gemini-I chip. The company has already announced and recently released its second-generation Gemini-II silicon, which it claims delivers roughly 10 times the throughput and even lower latency, all while further improving energy efficiency. If Gemini-I can match an NVIDIA A6000, what can Gemini-II do? That is the question every tech analyst is scrambling to answer right now. The company is explicitly targeting what it calls the $100 billion AI inference market. They are not trying